So imagine like a company just absolutely crushing its earnings, right? And they raise their financial outlook across the board for the whole year, and as a reward, the stock plummets 17.26% in a single day.
Yeah, I mean, it sounds completely backwards,
Yeah.
but that is exactly what happened on July 29, 2026 to, the digital infrastructure provider Vertiv, ticker symbol VRT.
Right, which is wild. But before we get into the mechanics of why that happened, a quick reminder for you listening. This deep dive is strictly for educational purposes. We are not licensed advisors, and this is not financial advice. So let's look at this central paradox. The numbers Vertiv reported were, well, they were huge.
They really were. Let's look at their profitability, right? Their adjusted EPS earnings per share. They delivered $1.52.
Wow, okay.
Yeah, and the Wall Street consensus was only $1.43. So they handily beat expectations right there.
Right, so they're making more profit per share than expected. But, I mean, a beat on a single quarter doesn't mean much if the future looks bleak. So I guess my question is, if the current numbers were that strong, did they raise their outlook for the rest of the year?
Or absolutely. They raised guidance across every major metric, so they bumped their full year adjusted EPS up to a range of $6.65 to $6.75.
Nice.
And they raised their expected net sales up to 13.8 billion to 14.2 billion.
Right.
They even pushed their adjusted free cash flow up to $2.4 billion to $2.6 billion.
And you said they're generating more cash and projecting more sales.
Mhm.
That 17% drop makes literally 0 sense. It's like acing a final exam but failing the class for being 2 minutes late. Because, right, the crash was triggered by a minor top-line miss of $3.274 billion in revenue.
Exactly.
And that was simply due to complex project timing shifts, right? Not an actual drop in demand.
Right, exactly. It's because of how revenue recognition works in these massive multi-phase data center builds. You can't officially put revenue on the books until specific construction and delivery milestones are hit.
That makes sense. Wall Street knows how construction works, though, so why the pure panic over a slight timing delay?
Because, well, Vertiv is a high multiple stock. When a company's stock price reflects massive future growth expectations, it's priced for absolute perfection. So any delay, even just a logistical one, gets aggressively penalized as an execution risk.
So they worried Vertiv couldn't physically scale fast enough to meet the AI boom.
Yeah, and that herd mentality kicked in really fast. 7 different analysts cut their price targets almost overnight.
7. Wow.
Yeah, Goldman Sachs cut to $301.1, RDC Capital to $337, Citigroup to $358.
That's brutal.
And it kept going. Bernstein Sagen to $358, Fox Advisors to $325, Mizuho to $300, and Daiwa to $340.
Right.
Okay, well, I actually have to push back a little on the market's panic here because, I mean, despite all those drastic price target cuts, these analysts mostly kept their buy and outperform ratings on the stock. They lowered the immediate price, sure, but their underlying thesis didn't change at all.
No, I agree. And the broader market quickly realized its mistake, honestly. The stock stabilized around $242 to $244 on July 31.
Right.
And from there, it initiated a really sharp 15% recovery bounce.
Yeah.
It was trading back in the $280 to $290 range by mid-August.
Okay, so synthesizing all of this for the listener, we have the earnings beat, the delayed revenue recognition, the Wall Street panic, and then the quick recovery. What is your final objective rating of Vertiv's earnings performance?
I'd have to give it an 8 out of 10.
An 8. Interesting. Why the 2-point deduction?
I'm deducting 2 points solely for those short-term execution risks. Scaling these complex multi-phase AI data centers does introduce logistical bottlenecks, but they earn that 8 because of their contractually binding $15.0 billion backlog.
Like that guaranteed future revenue.
Exactly. It shows incredible fundamental strength, especially when paired with their massive cash generation.
Yeah, it's a great reminder for you listening of why high multiple stocks demand absolute perfection. But I want to leave you with a final provocative thought to explore on your own.
Okay.
As AI server racks scale from 15 kilowatts to an unprecedented 600 kilowatts, the heat generated is going to be staggering. So will the physical constraints of heat eventually make cooling infrastructure companies command higher valuations than the AI chip makers themselves?